Welcome to our third quarter video update for the year 2021. Today, I have with me my fellow portfolio manager on the private wealth team, Maria Dawes, as well as our special guest, Glenn Murray, Chief Investment Officer and President of Capstone Asset Management. Welcome, Glenn.
Thank you, Janet.
Maria, would you do us the honor and kick us off with our first question to Glenn?
Certainly. So without getting too political here, can you comment on the recent federal election results and what if any implications might be, financial or otherwise?
Sure, I can definitely try. I don't think I can avoid being political and actually comment on the results. However, I think whatever one's political leanings are, most would agree that for an election that was apparently the most pivotal moment since 1945, it is probably fair to say that the outcome was both anticlimactic and an exercise in futility. In fact, the results of the election was the least popular elected government in Canadian history. So it's probably more beneficial for me to focus more on the potential implications. However, with essentially status quo in Parliament, it may be a challenge to see change from what has been experienced for the last couple of years, or even maybe back to 2015. As government today likes to have its hands in most areas, considering the implications of the election is extremely broad. I'll just focus on two areas that may be more interesting to our clients, those being real estate and the economy. So if we begin with real estate, affordability has been the main area of concern for years now. And unfortunately, I don't believe we will see much change on that front from the policies likely to be brought forward. At all levels of government, it tends to be politically rewarding to focus on areas that address public concern rather than the underlying fundamental issues. The result of this has been a focus on adjusting demand for real estate versus supply, when supply is really where the main problem lies. The governance platform does include an attempt to improve supply by building or renovating over 1 million properties. However, details are currently quite light, and the timeline appears to be over a number of years. This may help with the supply situation, but is too early to know. So at this point, I would say there will be limited impact to supply in the short to midterm from this. The other parts of the policy surrounding housing continue to focus on the demand side, and in some cases, I would suggest they could actually continue to stimulate demand. So I see little impact from policy to curb the market affordability or restrain the real estate market. There could be other triggers, but policy at this point doesn't appear to be properly focused. With a negative second quarter, the economy has probably underperformed expectations. However, with the third quarter appearing to be treading towards a better than expected performance, it could help to improve that situation. The current government's impact will not be at all clear until we start to see what happens with the fiscal stimulus that currently is supporting components of the economy. How and when this rolls off will have an impact, and it appears that they may get extended again now. But ultimately, an economy underpinned by government debt is going to be difficult to define as healthy. In addition, there has been a lot of discussion about areas to be taxed. This could be a problem for consumers, putting them under pressure, particularly when coupled with the removal of fiscal stimulus. For example, some areas we could see taxes increased or added are tax on flipping houses, on banks, minimum tax on higher externals, and tax on luxury cars, boats, and planes. With the government's stated policy of taking on debt so that we don't have to, I guess they must be need to pay for the spending some way. But with a potential impact to consumers and therefore knock on from that the economy is definitely something to be very mindful of. Indications from health authorities appears to show COVID will be with us in some form for a long time. So it does beg the question as to when government will remove the supports, as the longer it goes, the more challenging that will be. Overall, though, I would say it is really tough to see how things will be much different when we have the same party, the same plans, and the same parliament makeup.
Thank you, Glenn. So speaking of the economy, so far in 2021, we've seen an unbalanced economic recovery of sorts, if you can call it that. But we've seen a pretty strong stock market performance. Has the market decoupled from the economy? And if so, why?
Yeah, it's an interesting question as to whether markets are ever a true reflection of what is happening in the economy. We know that the market reflects the performance of the stocks that make it up, and the stock sales growth should be a component of their valuation, and this is impacted by the economy. So from that perspective, there is a link. However, for a stock market to reflect the underlying economy, the stocks making up the market must represent the full breadth of the economy. And the performance of each of those stocks must accurately reflect the growth of that sector or industry. So, is the market decoupling, or is the difference in performance of the market from the economy just becoming more pronounced than it may have been previously? The appearance of this decoupling became more obvious after the 2008 financial crisis, where we saw Main Street economic turmoil even after the recovery in the stock market was well underway. Some of this is due to the reality that there is a forward-looking component to investing in stocks, and therefore you would expect that the markets should lead out of an economic recovery. However, there are likely other factors that contribute to the market's performance being different to that of the economy. Firstly, it's fair to say that GDP growth is influenced by different factors than stock market growth. For example, the stock market is representative of the performance of the underlying companies. However, multiples paid for those stocks does not necessarily have a direct connection to what the overall economy is doing. And in the economy, the size of the workforce participation contributes to economic growth of a country, but does not impact the valuation of a company. During the financial crisis, the impact of monetary policy and quantitative easing on the stock market became increasingly apparent in the performance difference between Wall Street and Main Street. The sales growth of S&P 500 and GDP growth have significantly trailed the overall market growth since the financial crisis. So what has caused this? Partly, companies have used the access to cheap capital to strengthen their balance sheets through share buybacks, improved debt terms, and more liquidity by building up cash reserves. This has helped companies more than the general economy, as the cash reserves haven't been broadly reinvested into the economy. Also, the low interest rate environment and central bank intervention has persisted since the crisis, and that's increased investors' risk tolerance. And with investors looking for performance and feeling confident that the government and the central banks will continue to act in a stimulating fashion, it has resulted in increased participation and cash flow into the market. These factors have had a positive effect on market performance with much less impact to the economy. Now, more recently, the pandemic has contributed further to this, by the government's fiscal policy now providing both citizens and corporations with significant cash, and through the government's favoring of big businesses over small businesses by allowing many to remain open while the smaller businesses were required to close. The stock markets typically reflect the bigger businesses rather than the small privately owned entrepreneur business. However, the small business owner makes up a good portion of the economy. So the anecdotal evidence is that the increased involvement of government and central banks has likely increased the differences that already existed between stock market and economies, giving the appearance of decoupling.
Thanks, Glenn. So we still have a lot of uncertainty, and I think we can agree on that. But often as portfolio managers, Janet and I get asked about certain commodities, and many times that's gold. So what are your thoughts on gold and its current value?
Gold's a challenging and potentially polarizing topic, much like your first question around politics. So, however, I do believe it's generally accepted position that gold is a long-term store of value. In general, gold performs well when there are declining real interest rates, inflation is rising, and the US dollar is weakening. So, declining interest rates would mean that gold's present value is improving. The weakening of the US dollar means that gold is seen as a preservation of value. And as gold is a store of value, inflation will be its long term price driver, similar to what you experience in real estate. However, determining its true value is a challenge and not one that I spend time trying to figure out. Some form of valuation would be required to attempt to time the market buys and sells as an investment strategy. With an asset that is difficult to properly value, this can be a challenging endeavor to get consistently accurate and one that we avoid. With gold, I think it's more important to determine the role, if any, you want it to play in the management of your wealth. So assuming you do, then for most investors, there are a couple of roles that it could perform. And I believe this is how it provides its truest value rather than what its current price may be. The first role would be as a diversifier in an investment portfolio, and the second is an insurance against long-term uncertainty and risks. So firstly, we see many people use gold as a market hedge or a diversifier in their portfolio. This is because from a simple perspective, it has a low correlation to the stock market. This allows the portfolio to be hedged to a degree in negative markets due to that correlation. There are varying opinions as to what percentage of a portfolio should be allocated to it, but ultimately it should be a smaller percentage exposure. The other solution is to invest in gold as part of your overall net worth. So as we live in an increasingly uncertain world, having some of your net worth in an asset that can provide some insurance against aspects of that uncertainty could be worthwhile. In both these scenarios, it isn't the price that is important, but rather the role it plays that brings the investor value. In fact, in the role of the insurance, there is less concern for the price of gold as it's being put away for our long-term protection. The insurance role is the place I see the greatest benefit to gold, and I believe it is best accomplished by buying into gold on a regular basis and in a form that is as close to gold bullion as possible. This creates a long-term storage value as an insurance against uncertainty.
Glenn, I want to touch a bit on some recent events that have happened, and that is the Evergrande situation unfolding in China right now. The situation is surely dynamic, but can you give some general comments on the backdrop, perhaps, to how they got to that point? And is that a scenario that we could see happening in Canada? Why or why not?
Thanks, Janet. Yeah, you're correct. Very much is a dynamic situation. We can't even scratch the surface of the potential implications on this call. So let me focus on the background and briefly contrast it to the current Canadian market. To start, this really has its genesis in the opening of the Chinese real estate market in the late 1990s, when the government began to allow private home ownership. That decision allowed private citizens, particularly urban ones, to begin to own homes. This new freedom was the initial impetus for a property boom that has now lasted over 2 decades, and it was the start of a passion for real estate within China that has seen the Chinese population, and again, particularly those living in the cities, invest most of their net worth into the property market, and in many cases, into more than one property. This wave of purchases created excess demand that underpinned that property boom. The second element was the ease with which credit was available for property developers to build their companies out on. So with the apparent limitless demand and availability of easy credit, Evergrande built a business model that relied upon constant borrowing to satisfy the insatiable demand from the population. This has led the company to having over $300 billion in debt obligations. These obligations rely upon constant supply of capital from deposits, from new purchases occurring, and from the refinancing of their debt in order to meet those interest obligations. This business model really provides very little margin for market disruption, which unfortunately occurred at the beginning of 2021, when the government required property developers to meet 3 specific criteria to continue to receive increased financing. These are criteria that Evergrande does not meet and resulted in its borrowing supply line being cut off. With the significance of Evergrande's debt, and considering the number of property purchasers, suppliers, and investors, its implications to the Chinese economy are significant and far-reaching. The implications to Western investors who have provided capital to Evergrande are unknown until the outcome for the Evergrande situation becomes clearer. In the meantime, impact has already been felt by other property developers. A company called Fantasia missed a payment this week. Others have seen their stock and bond prices taking a hit. Additionally, beyond the sector, there have been implications to the Chinese high-yield bond markets as they've seen rates rising significantly. By comparison, Canada's real estate market has some structural differences that provide a different landscape. Structurally, banks are already regulated and have limits of exposure to developers as well as to components of the market, making it more challenging for developers to build Evergrande types of debt. However, that doesn't mean developers can't get overstretched in the same fashion that any corporation or person could. As mentioned earlier on the call, Canada has a supply issue, but where China has an oversupply, Canada is undersupplied. And government, as we've talked about, hasn't really been addressing this situation as they continue to focus on the demand side. With an supply problem, the property market in Canada has a basis of support. Finally, Canadians do enjoy strong levels of home ownership, but nothing close to the levels seen in China. And this difference increases even further when multiple homes are included in that picture. So the full fallout from Evergrande is unknown at this time, but it hasn't caught the market by surprise, and there will be some form of solution. However, it will have implications, and we do continue to monitor it closely.
Glenn, as we wrap things up today, I want to ask one final question, which is maybe less focused on the economy, but it's something I do get asked periodically, and that is, how are we doing as a firm in terms of our assets under management and also the types of clients that we are now managing? Could you comment on maybe what that looks like?
Sure. As a business, we do continue to grow our assets under management. We believe that we're offering a compelling investment solution to the market. We actively look for those solutions that we feel will improve and enhance the portfolios of our investors, and have most recently been spending time determining the best way to enter the impact market. This is a market we feel our expertise in non-traditional investments positions us well to serve, and believe this will provide our investors with unique opportunities to both diversify their portfolios, but also do so while making an impact in the world. With respect to our clients, I don't believe the nature of our client has changed dramatically over the years. We still look to serve the needs of both private and institutional clients, and do so through either a full discretionary management platform or by an approach that is mandate specific. Capstone continues to look to broaden its exposure to new clients, and we're always happy to receive any referrals from our existing clients that they wish to make.
Thanks, Glenn, for that. And it's always nice to have you with us, sharing your insights.
Yes, thank you so much, Glenn. It's been wonderful to have these updates. I think not only for Maria and I, who get the pleasure of hearing your thoughts, but for our clients as well. And the feedback has definitely been positive on this front. And to our viewers, we do take suggestions, questions, topics that you'd like to see covered. We'd love to hear from you. So please be in touch with us by phone or by email. Thanks, and bye-bye.
Bye.